Trading in volatile markets such as these can be quite scary. So we're speaking now to a trader who's been around for a few years, an experienced trader, let's put him that way. He is the steady trader. He's live from New York. He is Serge Berger. Thanks very much for joining us, Serge. It can be quite scary, can't it? So what is your advice then to people who are trading these kind of markets?
Well, I think at the margin, Sarah, people just tend to get very flustered, and volatility tends to get the emotions out of people. So what really needs to happen is when we trade these volatile markets is that we kind of, make sure that doesn't happen. So we need to take a step back, take a deep breath, and really let the trades come to us as opposed to us chasing the market either up or down. Because when markets are volatile, they tend to do sort of sharp U-turns in either direction. And if we're the last ones chasing these markets in the direction that they're going to, then we end up basically holding the bag.
So not forcing trades for some maybe traders who are used to doing, 50 trades a day, don't feel that that's necessary in these type of markets.
Yeah, exactly. I think as a general rule, most people that consider themselves traders tend to overtrade. And, a steady stream of trades is actually much more important than, say, doing 20 trades one day and then none for like a week. It goes a little bit against consensus thinking, which is exactly probably why that works. So when markets get volatile, it's really important that we just pick our spots really well and don't just let the intraday ticks get to us. So we need to let the trades come to us.
I'm sure one of the problems is when we see so much volatility, a lot of people see it as great opportunities to trade because we're seeing such huge moves. And I suppose people get carried away by that, can't they?
Yeah, exactly. So again, it all depends on what the time frame you operate in. But over the course of my nearly 20-year trading and investing career, I've found that the juiciest opportunities really exist sort of in a multi-day to multi-week time frame. And I think that actually particularly holds true in volatile markets as well. If you think about it from an intraday perspective, and there might well be opportunities intraday, but there are so many bits of news that can push you in and out of the market, particularly in a volatile tape, that it's difficult for most people to sort of grasp that type of volatility and pressure.
So keep your strategy, keep your plan in mind. Don't let it get overawed by what is happening in the markets. Is it a key tip then for you?
Absolutely, you have to plan your trade and trade your plan, and that's probably another thing that a lot of people don't do is come into the day with a plan. Let's say you come into the day and you're more equity focused like I am, and let's say your index is down 1-2% at the open. You might get all excited, but at the end of the day, that doesn't necessarily mean that there's a trade to be had right then and there. You have to let the market settle out. Again, let it come to you, and not force the trades. It's really a simple concept, but it's not as simple to implement. So we need to make sure we understand sort of the psychology behind it all, which is that these markets tend to get the best of our emotions, and as long as we can as long as our plan enables us to keep our emotions at bay, then that's the best thing to do. But it's not easy.
What about stop losses? We're always talking about how important it is to put stop losses in place. But when you're seeing such huge moves, of course, you're then getting stopped out so easily. So how do stop losses play into these kind of markets?
Yeah, it's a great question. And it goes back to the point I made before about the intraday swings being so volatile that stop losses are somewhat difficult to place. So, if you are going to play stop loss intraday, you have to keep your time frame right. So if you are doing intraday trading or something like that, then you better focus on like a 5-minute, 10-minute chart or something like that, and have your stop losses and price targets, in accordance with that time frame. A lot of people will go in and find a supposedly massive opportunity on an intraday basis, but then place their stop losses based on like a daily or even a weekly time frame, which makes completely no sense. So again, you have to make sure you operate within the time frame that you originally intended when you went into the trade.
I mean, this all sounds like common sense to, I suppose, to a certain extent. You've been in the markets, as you say, for 20 years. How difficult is it to learn all this, to take the emotions out, to start putting these I suppose, tips into play?
Well, it all starts with having a plan, and I think what a lot of folks do is they will try, basically a different plan every day or every week and in every different kind of market. And while there are different markets, our basic plan from a risk management perspective has to stay the same, right? So if markets get volatile, we still have to stick to our same plan. We might have to adjust our stop losses, from a standard deviation perspective and things like that. But our plan needs to remain the same. If you are, let's say, a momentum trader and you play breakouts or something like that, then when markets get volatile or whatever the market change is, you shouldn't just then all of a sudden turn into a dip buyer or something like that. It's a matter of sticking to your guns.
Okay, Serge Berger, the steady trader, thank you very much for joining us.
Thank you.